With all the recent market volatility around, I thought I'd share a couple of stories with you which might illustrate a couple of lessons we can learn when we're getting concerned about what might happen with investment markets in these sorts of times. The first one involves myself and my wife. In 1986, back before electricity, we were planning a trip to Europe which was going to take place in June of 1988. Now, we were a little bit short in terms of the amount of money we thought we might need for the holiday. We had saved around about $3,000 which we were going to use to help us to meet the expenses we were going to have on the very large trip. We were going to be away for about 6 weeks. So we needed to turn the $3,000 into about $6,000 pretty quickly. And we approached a financial advisor acquaintance of ours to give us some advice as to what we might do to invest the money and try and get a fairly substantial return over a short period of time. Of course, what happened was that in October of 1987 there was a share market crash, and indeed we did turn our $3,000 into $600, and so we had to find some other means by which we could accumulate the money that we needed to take our overseas trip. Now, we did hold on to that investment, and we kept until 1993 when we purchased our first house, and by then it had returned to its $3,000 beginnings. So the lesson to be learned is that if you wait for long enough, probably even during a downturn, the markets will actually do what they need to do and your funds will recover. The second story involves a client of ours, and we'll call her Betty for the purposes of this exercise. Now, Betty was a very intelligent lady who paid close attention to investment markets and subscribed to a number of newsletters from media commentators who were talking to her about the things that were going on in the world during the GFC. The $380,000 in her superannuation fund as the GFC worsened fell to about $350,000. And prompted by a number of these commentators, she called us and asked us to dispose of her investment. Now, we gave her a long conversation around investment markets and what might happen and holding for the long term and those sorts of things, but she was quite determined that she was going to sell out. So she realised a loss at that point of time of around about $30,000 from where her investment had been at the beginning. So the markets continued to fall during the GFC, and Betty looked like a genius. By the time her investment, had she not sold it, came to a point of being worth about $320,000, she called us again and said, "I think the market's fallen sufficiently. I think we've reached the bottom. I'd like to go back into the market now." So we invested $320,000 for Betty. Unfortunately, the market continued to fall, and when her investment reached $300,000, Betty decided it was time to go out again. This was the real bottom of the market. She'd been unable to time it. But sadly, I don't believe that Betty ever came back into the market, and so she'd actually made a real cash loss of about $50,000 during this period. Now, had Betty continued to hold her investment, which at that point of time was worth $300,000, it would today be worth something north of $1 million. But sadly, Betty was quite scarred by the experience, and she found that she was no longer able to take the risk associated with investing, and as far as I know, she just continued to hold her $300,000 in cash. So there are a couple of lessons we can learn here. The first one, from our story, when we wanted to turn some money into double the amount in a fairly quick period of time, is that this is very unlikely to happen. Investing is not punting. If we hold our investments for long enough, they will recover to the point at which we began and beyond. But if we simply wish to turn $3,000 into $6,000 over a short period of time, very, very unlikely to happen. The second one is you need to continue to hold your investments even during downturns unless you particularly need the cash. Selling out at one point and then buying in at a lower point is unlikely to be achievable. None of us can predict when the bottom of a downturn is, and none of us can predict when markets are going to continue to rise. It's simply a matter of holding the investments through the rises and the falls, which will give you the best results. So unless you need the cash, there's no concern now or in the past at having to sell down on your investments. If you remain invested, you're going to get the best result. Look forward to talking to you again soon.